So this is the way I try to help people understand multiples and all this stuff. I always, because a lot of the valuation, I mean, there's books, volumes written on the proper way to value stuff. I mean, I try to look at it in kind of plain vanilla terms. And this is a chart that I use to try to help people understand what these risk rates mean. So assume that you had EBITDA, we'll call that cash flow, of $1 million. And you had a required rate of return of 100%. That'd be a 1 multiple. The value would be $1 million. Let's go down to here, more like it. You made $1 million of cash flow, and the required rate of return was 20%, or the risk associated with that $1 million cash flow is 20%. That's a 5 multiple. That means the value of that business is $5 million. Right? That's the math we just went through. This is the way I think about it. A 5 multiple says that I'd be okay as an investor to wait 5 years to recover my capital. Very kind of, let's think about it and get down to brass tacks. If I spent $5 million on a company to get this $1 million back, theoretically, that means that those cash flows, you know, I'm reasonably assured that I can recover my money in 5 years. Okay? If I'm up here, what do you think the characteristics of this business are? If I had a 1 multiple and had $1 million of cash flow, but I'd only be willing to wait 1 year to get it all. What do you think the characteristics of that look like? Anybody? Somebody? It's risky, right? There's got to be something, right? And realistically, you never see something like this. But as an example, you know, that would be highly risky, right? If you're saying basically it's not predictable, you know, you'd wonder why you'd pay anything for that. But by thinking about when you hear multiples, just think of number of years it takes me to get my money back. So if you have a company, this is actually realistic here for smaller companies. I'll show you a chart in a minute. Smaller companies, smaller in size, a lot of variability of earnings, owner-dominated companies that don't have management staffs. You know, you're here. You know, you could be in the 2 to 3, like, you know, think about the corner laundry type of a company. Those don't trade for big, right? Because what are the characteristics of how they're run? What's the big item? It's a job for somebody, not so much a business, right? You know, unless you buy 20 of them, if you feel like it, God forbid. But if you look at the typical, like, you know, the corner store variety business, why don't they ever create a lot of value for the people that are in them? The reason is that they're jobs for them. They're not businesses. And so the idea is that, you know, if you're going to buy it, there's no predictability to the cash unless you go in there, right? And it becomes your job. If the person leaves and they do everything, okay, now you got to find the people. You got to do all. They don't create a lot of value because it's, you know, there isn't anything that easy about continuing the cash flows. You got to go in and make sandwiches every day. That's why those little businesses are way down here. But even small businesses that, what I'll call, if you want to read that E-Myth book, the owner-dominated business that doesn't have a management staff. Like if you look at our firm, you know, I could get hit by a truck tomorrow and our firm is going to keep going. I mean, it's a blip here. I mean, I've got great partners. We have 200 associates here. Any one of us, if something happened, God forbid, that was bad, we'd have to adjust for sure. But you know, our clients are still going to be served tomorrow. Somebody's going to open the door, right? The IT systems are going to work. Stuff's going to happen. That management staff, those systems and procedures create value in a business. If we had a situation where I did everything and we didn't have a dispersed responsibilities, like today, I got in here and I set my machine up. Our IT person, I was leaving, I went out and used the men's room and came back in, and our head of our IT department was here making sure it was okay. Like, that was really good because she knows we have a presentation. Our procedures are that they have a presentation. Someone on the IT staff's here to make sure the equipment's working, and I don't really screw it up. But like, that's a good thing. Like, that's an example, small example, but that's why, what adds value to the business is when you have a management staff that it can run without you being there. It adds a lot of value. Yes, Phyllis?
Wait, am I talking too much?
No, it's okay.
But I was actually thinking of Kreischer Miller, knowing you for a long time, but I don't think that my reputation, your reputation hasn't always been that way with Kreischer Miller. So I think that you probably have done a lot of strategic planning over the years to get the firm in this situation now, right? So that it's not all about, Kreischer or Miller.
Right. Well, yeah, it takes time. Certainly when we were a lot smaller, I started here, I think I was the 18th employee 30 years ago. I mean, that wasn't a business that was worth a lot. There was really, only a few people. Barney was with us then. But it, so yeah, I'm not saying that you snap your fingers and this stuff happens, but if you're thinking about increasing the value, this stuff should be on your radar, right? So it's taken us a lot of time to keep growing. Arguably, depends on how you want to make money. You could look at it and say, okay, take everything out or reinvest it. Have great training, attract college kids that we can train, right? That stuff is what, creates long-term value, but there's trade-offs. You have to reinvest money in training and people in order to build systems and processes that lets the business work for you. And so in our case, that has been something that we've spent time intentionally working on. Is it perfect? Not close, but it's improved. We continue to try to work at it so the business isn't dependent on one person. So the point of this, though, for your sake, when you think about risk, this is what I would say. You're not a finance person, and you want to just think, well, what does risk mean? How do I sort of equate it to day-to-day stuff? Think about number of years on the implied multiple. If somebody says, I'd pay you 3 times or I'd pay you 6 times. Think about that's the number of years you'd be willing to wait till you got your money back. How comfortable do you feel? Remember about that cash flow confidence? How confident am I? If I'm highly confident, maybe I'd wait for 6 years. If the business is all over the place, unpredictable, not well managed, heavy customer concentrations, I only may be willing to wait 3 years till I got my capital back, right? So to me, this is a chart for you to sort of bring the discussion down to, brass tacks, more real world discussion about, quantifying risk and all that. The way I think of it is number of years till I get my money back. If I'm going to be waiting 10 years, it better be, right, really good. The predictability of that cash flow to wait that long has got to be off the charts, right? Likewise, if it was 1 year, you probably wouldn't touch it. So you're somewhere in the middle probably, and I've highlighted those same years where 4 to 7 times seems to be what we see when transactions actually happen. That seems to be, we've had some above that, we've had some below that, but the larger propensity of what we see in middle market companies is somewhere in that range. So if you're looking to establish, a valuation model for how you look at your own business, it's probably somewhere in there.